Okay, let's unpack this. Welcome to the deep dive, where we take concepts that sound overwhelmingly complicated, the kind of topic that makes your eyes glaze over in a textbook, and turn them into insights that fundamentally change how you view your own finances.
Today, we're undertaking a really comprehensive deep dive into the architecture and the mathematics of annuities.
Annuity.
For a lot of people, annuities live in this sort of fuzzy world of retirement products sold by insurance agents. They sound complex, but at their heart, they are probably the most essential financial building block.
That's right. When you strip away the sales pitch, the core idea is stunningly simple. Our source material gives us a concise and powerful definition.
What's that?
An annuity is just a series of uniform payments or receipts made at perfectly equal time intervals, usually over a specified term.
And that's our mission today.
Exactly. The mission is to quickly and thoroughly understand the foundational types, the exact valuation methods, and the practical calculations that underpin everything from your home loan to your retirement security.
To immediately ground this abstract math in your daily life, just think about the routine cash flows you already handle.
So many of them are annuities.
They really are.
The consistent deposits you make into your savings account week after week or maybe month after month, that's an annuity.
Your inescapable level monthly home mortgage or car loan payment,
That is absolutely an annuity.
the annual or monthly premiums you send to your insurance provider,
Also an annuity.
and, of course, the classic retirement scenario, regular pension payments coming to you. The consistency of these payments, that regularity, is what allows us to apply some really rigorous mathematics.
So why does that regularity matter so much?
Because it lets us apply the time value of money, but in a highly efficient, sort of summarized way. Instead of calculating the present value of, say, 360 separate mortgage payments, we can use a single factor to calculate it all at once.
So it's a shortcut.
It's a massive shortcut. The value of an annuity is always expressed as either a present value, which is the lump sum those future payments are worth today, or a future value, which is their total accumulated worth down the line.
And we use specialized interest rates to either discount for the present value or accumulate for the future value.
Precisely. And the interesting real-world context here is that while the math is pure finance, the contracts themselves are, well, they're overwhelmingly issued by life insurance companies.
Why them specifically?
They're the entities best suited to manage the risks inherent in guaranteeing that regular income, particularly for things like retirement or survivor benefits.
Right. And as we'll get into, that insurance context introduces the most mathematically complex and frankly fascinating element.
Yeah.
Mortality risk.
It does. But you can't build the roof until you have the foundation, so we absolutely must first master the structure of the simple guaranteed annuity.
That sets the stage beautifully. Now, before we look at a single formula, we have to grasp how these things are categorized.
Yes, this is crucial.
Because the way an annuity is classified determines exactly which formula you pull off the shelf. If you mix up the type, the calculation is worthless.
Our source material breaks annuities down across 4 distinct but often intertwined dimensions. We need to walk through each one because they really define the structure of the payments.
Let's start with what seems to be the most critical distinction for valuation, something that changes the math right away: the timing of payments.
Yes. This gives us the annuity-immediate versus the annuity-due.
Here's where we move beyond simple definitions and into financial architecture.
The standard default structure, the one used for nearly all loan repayment schedules, is the annuity-immediate, or you might hear it called an ordinary annuity.
Okay, and the core rule here is what?
Payments are made at the end of each period.
At the end. And the reason for that timing is really deeply ingrained in lending practices, isn't it? It reflects how interest accrues.
Exactly. When you take out a loan, you use the money for the first month. Interest accrues on that principal over those, say, 30 days.
So when you make your payment at the end of the month,
You are covering the interest that accrued during the preceding period, plus a little bit of principal reduction. The payments are always in arrears. Your home mortgage is the perfect example.
right. Now, if that's the default, why do we need the alternative, the annuity-due?
The annuity-due just flips the timing. Payments are made at the beginning of each period. They are paid in advance.
That small shift changes the math entirely, as we'll see.
It does, because that first payment is made at time 0. It gets a whole extra period to compound interest compared to a payment made a month later.
And the examples here are things where you pay up front for the right to use an asset or receive a service.
Exactly. Rent is the most common example. You pay on the first of the month to use the apartment for that month.
Insurance premiums, too.
Insurance premiums operate the same way. You pay in advance to cover the risk during the upcoming period.
So payment at the end for obligations like loans, that's immediate. And
Wow.
payment at the beginning for rights or services like rent or insurance, that's due.
That is a powerful and necessary mental shortcut you need when you start tackling the math.
Okay, let's move to the second dimension. Contingency of payments.
This one defines the duration of the payment stream, specifically whether the term is certain or if it's based on human survival.
So first we have the annuity certain, which I assume is the financially straightforward version.
It is. This pays over a fixed known period. The number of payments, we call it N, is set in stone in the contract, say, 10 years or 360 months.
And that payment schedule will be completed no matter what.
Regardless of whether the individual receiving the payments lives or dies, the uncertainty is removed entirely.
But once we introduce human life, we get the life annuity.
And here, the payment is contingent upon survival. It pays only while one or more specified lives survive. The number of payments is therefore uncertain because it's entirely dependent on longevity.
This is the cornerstone of pensions that provide income for life.
Exactly. Payments cease the moment the annuitant passes away.
I find this distinction so fascinating because it highlights the fundamental difference between pure finance and actuarial science.
How so?
Finance deals with known cash flows, while actuarial science has to deal with expected cash flows.
Absolutely. And of course, the industry has created a hybrid, the certain and life annuity.
Which is also known as a life annuity with period certain.
Right.
It sounds like a hedge against dying too soon.
That's precisely what it is. It guarantees payments for a minimum term, let's say 10 years, even if the annuitant dies early.
And then after that?
And thereafter, payments continue for as long as the annuitant is alive.
So if the annuitant dies in year 3,
The beneficiaries still receive payments for the remaining 7 years of that guaranteed term. It offers a balance between the risk management of a life annuity and the security of a fixed-term guarantee.
okay, our third classification, this one looks at how the investment return is calculated. Variability of payments.
This is crucial for long-term planning because it dictates your risk profile. The safest option is the fixed annuity.
Fixed. So the insurer just declares a fixed interest rate.
Yes, and that rate provides a guaranteed minimum return on the underlying account value. It's all about stability and predictability. You know exactly what you'll get.
Then you jump onto the risk and reward spectrum with the variable annuity.
This is where you, the consumer, take on the investment risk. Your premiums are invested directly in what are called sub-accounts, which are often structured just like mutual funds.
So your contract value and your future income payments can fluctuate.
They fluctuate directly with the underlying investment performance. High market returns mean higher payments. A market crash means your income stream can shrink.
So the insurer is managing the mortality risk, but the policyholder is managing the market risk.
Correct. And then, sitting right in the middle, attempting to offer the best of both worlds, is this specialized structure known as the equity-indexed annuity.
Right. These are often marketed very aggressively because they seem to promise market upside participation without the market downside risk. How does the structure actually manage that balancing act?
Well, they credit interest based partly on the performance of a specified market index, like the S&P 500. But, and this is the key, they impose contractual restrictions to limit the risk.
What are those key rules?
The two big ones are the cap and the participation rate. The cap is the maximum rate you can earn in any given year, even if the index skyrockets by, say, 20%.
And the participation rate.
A participation rate dictates what percentage of the index's gain you actually receive. So if the index gains 10% and your participation rate is 70%, you only get credited with 7%.
So you trade unlimited upside potential for a layer of protection.
Exactly. And that protection is the third crucial feature. They always include a minimum guaranteed return. If the market index drops 30%, you earn 0 from the index, but your contract value won't fall below that minimum guarantee. It protects your principal.
It's a very complex risk transfer mechanism.
It is. Finally, the fourth classification, deferral of payments, which just adjusts the timing of when the income starts.
This is simply about whether you need the money now or later. We start with the immediate annuity.
Right. Often called a SPIA, a single premium immediate annuity.
And how does that work?
This is purchased with a lump sum, and the income payments begin shortly thereafter, typically within 1 year. This is the product of choice for someone who has just retired, has a large sum of cash, and wants to immediately convert that capital into a steady, reliable income stream.
And its counterpart is the deferred annuity.
The deferred version is the accumulation phase product. It starts income payments only after a specified deferral period, which might last for decades.
And during that deferral period?
The capital grows tax-deferred, earning interest or investment returns, until the policyholder decides to annuitize and begin taking income.
And it's important to synthesize these classifications. Any of the variability types, fixed, variable, or indexed, can be written as either an immediate or a deferred contract, right?
That's right. The structure of the investment return is separate from the timing of the payout phase.
So if you're 35 and planning for retirement,
You might buy a variable deferred annuity, hoping for maximum accumulation growth over 30 years before starting the income stream.
and if you're 65, ready to retire.
You might buy a fixed immediate annuity for immediate guaranteed payments.
We've built the scaffolding. We understand the four defining characteristics. Now we can transition to the actual mechanics. How do we take a stream of 300 guaranteed payments and accurately summarize their value today or tomorrow?
We are now focusing entirely on the annuity certain, where the term N is known.
And the valuation process is, you said, elegant?
It is. It's purely the summary of that stream of predetermined cash flows into a single value. It's the ultimate time-saving calculation.
And this math hinges on knowing two things: the effective interest rate per period, which we call a dollars, and the number of total payments, none.
Let's start with the standard structure. Annuity-immediate, so payments are at the end. When we value these, we use specific factors, which are essentially mathematical shortcuts.
So you multiply the periodic payment, R, by one of these factors to get the total value.
Exactly. First up is the present value factor. Instead of reading out the complex algebraic notation, let's just focus on what this factor does.
Good idea.
We can just call it the PV factor. Its purpose is to discount every single future unit payment back to time zero. If you had 60 monthly payments, this factor saves you the painful task of discounting payment 1 by 1 month, payment 2 by 2 months, and so on.
All the way to payment 60.
Right. It collapses the entire liability or asset into a single lump sum today. Conceptually, the formula is built using the math of a geometric series.
You're just summing up the present value of dental payments, each discounted by an increasing power.
Yes. And that underlying structure is what allows it to simplify so beautifully into that closed form equation. When you multiply the PV factor by your recurring payment R, you get the total present value.
Okay, now let's look at the other side of the timeline, the future value factor.
This factor accumulates the payments forward. It tells you the total cash value, all the payments, plus all the compounded interest, immediately after the very last payment is made.
This is what you'd care about if you're trying to hit a savings goal.
Precisely. And what's crucial is that these two factors are inherently linked. They are just two sides of the same coin, separated by time.
Meaning, if you know the present value.
If you know the present value of an annuity, you can calculate the future value simply by accumulating that PV forward over non-billy periods at the given interest rate. The two values must be consistent with the time value of money.
Let's make this real. The source material gives a great example involving a 5-year annuity.
Yes, a nominal annual interest rate of 12% and monthly payments of $100. We need to find the present value.
Okay, this is a fantastic teaching moment because it requires the mandatory first step in annuity math.
Rate adjustment.
Rate adjustment. We have a nominal annual rate of 12%, compounded monthly.
Since payments are monthly, we must use the effective monthly rate. So 12% divided by 12 months equals an effective periodic rate, $1 of 1%, or 0.01.
And the term adjustment. 5 years of monthly payments mean $1 equals $60 of periods.
So we are calculating the value of 60 future $100 payments at a 1% monthly rate.
We take the $100 payment and multiply it by the PV factor for 60 periods at 1%.
And running those 60 monthly payments through the PV factor formula, we find that the factor is roughly 44.955.
Meaning that if you multiply that factor by the $100 monthly payment, the total present value is approximately $4,495.50.
And think about what that number really means.
Go on.
$4,495.50 today is the exact financial equivalent of receiving $100 at the end of every month for the next 5 years, assuming you can earn a 12% nominal rate on your money elsewhere.
It gives you immediate clarity on the current worth of a future income stream.
Exactly.
We just calculated the standard annuity immediate. Now we look at the minor structural change that introduces a significant financial difference. The annuity-due formulas.
Right, where payments happen at the beginning of the period.
The good news is we don't have to start from scratch.
Not at all. The mathematics of the annuity due simply builds upon the annuity immediate, thanks to that one extra period of interest.
Because every payment is made one period earlier, it has one more compounding cycle.
Precisely. This means the present value factor for an annuity due is simply the annuity immediate factor multiplied by 1 plus I.
And that 1 plus I factor might look tiny, especially if a wallet is small. But over a long period of savings or investment, that small factor represents the difference between constantly playing catch-up and getting ahead.
It absolutely encapsulates the exponential power of early investment, and the same relationship holds for the future value factors. The annuity due future value factor is the annuity immediate future value factor, also multiplied by 1 plus I.
Let's apply this to a future value example, which is typically used for calculating retirement savings goals. We are finding the accumulated value of a 7-year annuity due with a nominal annual interest rate of 9% and monthly payments of $100.
Again, we normalize the inputs. 9% divided by 12 months gives us an effective monthly rate of 1,00075.
And the term is 7 years times 12 months, so $1 is equally 84 4 payments.
So we're solving for the accumulated value of 84 payments of $100 made at the beginning of each month, compounded at 0.75% monthly.
The source calculation shows that the annuity due future value factor for these parameters is approximately 117.3001.
If we multiply that factor by the $100 payment, the final accumulated value is approximately $11,730.01.
And that total represents the full value of all 84 deposits, plus all the compounded interest earned measured immediately after that 84th and final deposit hits the account.
We must now address perhaps the most abstract yet foundational concept in finance theory, the perpetuity.
This is literally the annuity that never, ever ends.
Payments continue indefinitely. While they're rare for individual consumer products, the mathematical structure is vital for valuing long-lived assets like certain stocks or government bonds.
The fundamental question is exactly what you asked earlier. If the stream of payments goes on forever, how can we possibly assign a finite value to it today?
And the answer lies in the discount factor. The further out a payment is, the more heavily it is discounted back to time zero. Eventually, the present value of a payment 10,000 years from now is, well, it's infinitesimally small.
So we use the limit function.
Exactly. The present value of a level perpetuity is obtained by taking the limit of the annuity immediate PV factor as the term $1 tends to infinity.
Because the interest rate dollars is positive, that time factor we saw in the formula, 1 plus I, to the power of negative n, it completely disappears as n approaches infinity.
And the formula collapses into something remarkably clean. The closed form for the present value of an annuity immediate perpetuity with payments of R is simply R divided by I.
R over I. That simplicity is staggering.
It is. It allows financial analysts to quickly estimate the fundamental value of a permanent income source. To ground this historically, look at something like the British consul's perpetual bonds issued by the British government, sometimes centuries ago.
They paid interest forever.
Forever, with no maturity date. Their market price was a reflection of the discounted value of that infinite stream of payments. It's R over I in action.
And what about the annuity due perpetuity, where the payment is made immediately?
Since the payment is made at time zero, it earns that first period of interest. Its PV factor is 1 over D, where D is the effective rate of discount. But crucially, the PV of the annuity due perpetuity is logically 1 plus I times the PV of the annuity immediate perpetuity. The relationship holds, even with infinity.
We've mastered the core math of guaranteed cash flows. Now we pivot to the two most important applications of these formulas in the real world: the architecture of loans and the management of survival risk.
Starting with amortization calculations. This is a structure that defines virtually every mortgage, student loan, or auto loan you might encounter.
When an annuity is used to repay a loan with level payments, it is universally treated as an annuity immediate.
Right, because as we established, each payment is made in arrears, covering the interest accrued since the last payment.
So the entire mathematical goal is to make sure the present value of all those payments exactly equals the initial loan principal.
Exactly. The genius of the amortization formula is that it calculates the precise level payment, R, required to hit that zero balance target on the very last payment.
And that level payment R is calculated by taking the principal P and dividing it by the PV factor for the loan term.
That's right. The formula looks a bit intimidating, but it's simply reversing the present value calculation we already discussed. It dictates your monthly financial commitment for decades.
Once we know R, the question quickly becomes, how much of that debt is left? We need to calculate the outstanding loan balance after, say, no payments.
And banks and borrowers use two methods to do this, both of which yield the exact same result. The first is the retrospective method, which looks backward from the loan's starting date.
Retrospective. So you start with the original principal, you accumulate it forward with interest as if you made no payments, and then you subtract the accumulated value of the payments you did make.
It's an accounting method, really, used to verify the total interest charged and payments received up to that date.
But there's an alternative.
Yes, and often mathematically cleaner for planning is the prospective method. This one looks forward from the current point in time.
So you just treat the outstanding balance as the present value of the remaining payments. You calculate it by taking the level payment R and multiplying it by the PV factor for the remaining payments.
This method is favored for financial planning because it's quicker and directly tied to the future obligation. If you were a lender selling the loan to another institution, you'd calculate its value using the prospective method.
Let's apply the source example to see this equivalence in action. We have a loan principal P of 1,000, a pretty high rate of 10%, and a short term of 3 annual payments.
First, calculating the level payment R. Using the amortization formula, we find the annual payment required is approximately $402.11. That payment ensures the debt is precisely paid off in 3 years.
Now let's find the outstanding balance after one payment, B1, using the simpler perspective method.
Okay, so we need the present value of the remaining 2 payments at 10%. The PV factor for 2 periods at 10% is approximately 1.7355.
Multiplying the payment of 402.01 by that factor gives us an outstanding balance after 1 year of approximately $697.89.
And if you use the retrospective method, accumulating the 1,000 for 1 year and subtracting the future value of that first payment, you would get the identical number.
The financial mathematics is robust. A look backward and a look forward converge on the same current debt level.
Exactly. And just as a quick footnote, even though most loans are annuity-immediate, if you encountered an unusual loan where the payment was due at the beginning, you would simply use the annuity-due PV factors. The methodology of amortization doesn't change, just the specific factor you use.
Now we transition from pure finance, where N is known, to actuarial science, where N is dependent on human existence. Life annuities introduce mortality into the equation.
This fundamentally changes the risk profile and the math. This is the crucial intersection of insurance and mathematics.
So we're dealing with payments that are conditional upon the annuitant surviving to receive them.
Which means we can't use the simple annuity certain formulas anymore because we just don't know the term. We have to use expected values.
We have to calculate the actuarial present value, or APV.
Exactly. The APV is the expected value of the discounted payment stream. It's not the guaranteed value, but the statistically probable value derived by pooling large amounts of population data.
So what's the core tool we need from the actuarial side?
We need the probability of survival, which we denote as TPX. This is the probability that a person currently aged X will survive for at least more periods. Actuaries derive this from massive amounts of data compiled into mortality tables.
Right, which track how large groups of people pass away over time. So if I'm a 60-year-old, age X, buying a life annuity, the insurer needs to know the probability that I'll be alive at age 70.
Right, where T equals 10. And for every single payment, that probability is factored in. The APV calculation is a summation that runs from the first possible payment all the way to the maximum possible human lifespan.
So you're summing up the present value of every dollar, but weighted by the chance that the person will still be around to collect it.
And this framework is what allows the life insurance company to manage longevity risk, the risk that you live much longer than average and they have to keep paying you.
They can't predict your individual lifespan.
No, but by pooling thousands of lives together, they can reliably predict the average payout duration for the entire pool.
So if we look at the standard actuarial notation for a whole life annuity immediate of 1 per year on a life aged X, it's written as A sub X.
And that factor is the sum of all future discounted 1 payments, each one weighted by the probability of survival, TPX.
And if it's a whole life annuity due, it's a double dot X, and the summation just starts at time T0 to account for that immediate first payment.
Right. And this math is the reason life annuities offer such unique financial certainty. You give up control of your principal, but in return, the insurer assumes the longevity risk, guaranteeing you an income stream you cannot outlive.
It's a powerful trade-off, and it's rooted entirely in the math of expected values.
For our final section, we pivot to the crucial inverse calculation, solving for the payment R.
Right. In practical financial planning, you rarely start knowing the payment amount. You usually start with the goal. You know the lump sum you have today or the lump sum you need tomorrow.
And you need to determine the required periodic deposit or withdrawal. We'll focus on the annuity-due scenario here, as it's often used for planned withdrawals from a retirement fund or consistent savings contributions.
Let's start with present value to payment, annuity due. This is the income generation scenario.
Yeah.
You have a starting lump sum, A, and you want to know the maximum level payment, R, you can withdraw over a fixed term.
Since we know that the present value A equals the payment R multiplied by the annuity due factor, we just divide the lump sum by that factor, R equal A divided by the A double dot factor.
Okay, let's work through example 1. You have A, $70,000, and you plan to withdraw annual payments over 3 years, assuming an effective interest rate of 15%.
First, we need to calculate the annuity due factor for 3 years at 15%. This factor, a double dot angle 3 at 15%, is approximately 2.63.
So we divide the $70,000 principal by the factor 2.63.
Which requires a level annual payment R of approximately $26,659.47. That is the precise amount you can withdraw at the beginning of each of the next 3 years before the principal is exhausted.
Example 2 gets more complex by introducing quarterly compounding. We have a present value A equals $250,700 with quarterly payments for 8 years and a nominal annual rate of 5% compounded quarterly.
We normalize first. 8 years of quarterly payments means N equals 32 total payments. The rate is 5% divided by 4, so I is 1.25% per quarter.
So we need the annuity due factor for 32 periods at 1.25%.
That factor, a double dot angle 32 at 1.25%, is calculated to be about 26.57.
Dividing the starting principal $250,700 by that factor of 26.57.
Yields the required quarterly payment? R. That level quarterly payment is approximately $9,435.71. This is the kind of calculation that lets financial institutions instantly determine a sustainable withdrawal rate from a trust fund.
Now for the final mathematical application. Accumulated value to payment, annuity due. This is the savings solution.
Right, you know the future value, S, you want to reach, and you need to calculate the minimum payment, R, required to hit that target.
So we use the accumulated value factor. Since the accumulated value S is R multiplied by the future value factor, we divide the target S by that factor.
R equals S divided by the S double dot factor.
Example 3 involves monthly payments. We want to reach an accumulated savings goal of S if it's $55,000 in 3 years. The nominal rate is 15% compounded monthly.
We adjust the parameters one last time. 15% divided by 12 gives us a monthly rate, I, of 1.25%. The term is 3 years times 12 months, so N is 36 payments.
We need the annuity due accumulated value factor for 36 periods at 1.25%.
Plugging in those numbers, the factor S double dot angle 36 at 1.25% is approximately 45.68.
And if we take our $55,000 target and divide it by that accumulation factor of 45.68, we get the required monthly deposit.
That precise monthly deposit made at the beginning of each month for 3 years is approximately $12,204.04. This is the hard financial discipline required to meet that specific savings objective. It proves the feasibility and the cost of the goal instantly.
So what does this all mean for you, the well-informed listener? We started with the definition of a regular payment stream and ended with the powerful formulas that structure billions of dollars in finance daily.
The biggest takeaway is really twofold, and it's centered on those key structural distinctions. First, always remember the difference between annuity-immediate and annuity-due.
Immediate is for loans, due is for savings and rent.
Exactly. Immediate is payments in arrears, due is payments in advance. That timing difference introduces that crucial 1+I factor into all calculations, which is so vital over long compounding periods.
And second, the distinction between the certain and the uncertain.
Annuity certain use is known, fixed terms, making the calculation straightforward. Life annuities introduce actuarial science, replacing the fixed term N with the probabilistic factor of survival, TPX, allowing insurers to pool and manage the risk of longevity.
These mathematical tools are indispensable because they allow us to rationally equate a single lump sum today, whether it's a mortgage principal or a retirement nest egg, with a long stream of future cash flows.
And before we wrap up the financial discussion, let's briefly touch on the global context. We mentioned that while the mathematics is universal, the products are governed by national regulations.
Right. Our source material notes that annuities operate under different legal regimes globally: American, European, and Swiss law.
And while PV equals R over I holds everywhere, the rules governing how these products are issued, what guarantees must be offered, the tax implications, the solvency requirements.
They're all highly specific to those jurisdictions.
It means an index-linked annuity offered in the U.S. will have different consumer protections and tax treatment than a similar product offered in Switzerland. The financial product is truly a blend of math and law.
And finally, let's return to the idea that allows us to connect the abstract mathematics back to the economy at large.
Yeah.
The perpetuity.
We established that the present value of an infinite stream of payments, R, is simply R divided by the interest rate I.
And this simple ratio means that the higher the interest rate I, the smaller the present value becomes. If you could earn 1,000% interest, then an infinite stream of $100 payments would be worth almost nothing today, mathematically speaking.
It raises a profound question about economic perspective. The valuation of a perpetuity demonstrates just how heavily we discount future income based on current opportunity cost.
When money is expensive, when interest rates are high, we place a lower present value on tomorrow's certainty.
Conversely, in a low-rate environment, the value of that future cash flow stream skyrockets.
The interest rate is not just a number on a spreadsheet, it's a measure of how much we currently value the future. It's a fascinating thought to mull over the next time you hear a central bank discussing rate hikes. We hope you enjoyed this deep dive into the mathematics of annuities.